For years, I was a losing trader. Deposited $10,000, quickly lost it. Reloaded, went broke again. Put up more money, back in the hole. By this time, I already watched countless YouTube videos. I knew about moving averages, price action, RSI, Fibonacci, MACD, Bollinger Bands, Head and Shoulders. I tried crypto, forex, stocks. Nothing was working. I kept a spreadsheet of my results, and the most frustrating part was I was winning about 60% of my trades, but somehow was still losing money. I heard that most traders lose, but that doesn't mean all traders lose. Some win year in and year out. I wanted to learn their secret. My big breakthrough came when I came across a report that analyzed 12 million trades over the course of a year. Much to my delight, they found a few key differences that separate winning traders from the losers. The first chart we have is the percentage of trades that closed in profit. Other than the first pair, which was just under 50%, traders won more often on 14 out of 15 pairs. I've recolored these to make it easy to see. The first thing that jumped out at me is trading is not random. Try flipping a coin a million times, having it land on heads 54, 60, or even 71% of the time. Not gonna happen. But at this point, I didn't want to get too excited. Because after all, even I was winning 60% of my trades, but was losing money hand over fist. Before I could get my hopes too high, the article goes on to state that overall traders lose money despite being right more than half the time. Now that caught my attention. Somehow I was in the same boat with these thousands of other traders, winning, but actually losing. On a personal level, it was easy for me to be in denial as a losing trader. In the back of my mind, it wasn't my fault. I was just getting unlucky. Or maybe the market's rigged. Big players have all the inside information. Brokers give me bad executions, or hedge funds hunting my stops. But if I'm being honest with myself, when there's a sample of 12 million trades across thousands and thousands of people who are right more often than they were wrong, but still losing money, something doesn't add up. I had to admit we were all doing something fundamentally wrong, but I couldn't quite put my finger on it until I saw the next chart. Let's look at the first forex pair here, Euro USD. We already know that traders are winning 59%, but that's only half the story. Here it breaks down in blue what they win on average per trade, and in red what they lose. When they're right, they win 65, but when they're wrong, they lose almost twice as much. Let's say someone took this trade 100 times. 59 times they win 65 for a total of 3,800. Out of 100, if they win 59, that means they lose 41. They lose 127 each time for a total of negative 5,200. So what that means is after 100 trades, even though they won more than they lost, overall they'd be down almost 1,400. Bottom right, it seemed traders were winning 14 out of 15 pairs. I was curious about the other pairs, so I ran the math. In reality, they actually lost money 13 out of 15 times. Take, for example, GBP JPY. Traders won a healthy 66% of trades. It sounds good until you see they're actually down overall because the losses are 235% larger than the wins. When I was a struggling trader, one of the biggest mistakes I made was only focusing on my win rate and not learning what to do when things went wrong. Mike Tyson is famous for saying, everyone has a plan until you get punched in the face. Think about trading like you're in a boxing match with the market. You land a couple light jabs, you take your profit early, you're feeling good about yourself. But every time the market fights back, it's like an uppercut to the chin. What I didn't understand was in the end, the small wins aren't going to be enough if I'm sustaining so much damage when I take a loss. Looking from the outside in, now it seems pretty obvious that having small winners and large losers is a bad idea. It's clear what the problem is. The bigger question is, why is it such a common issue for so many people? Listen very carefully. The keys to the kingdom are on the next page of the article. It says the advice is actually simple. The problem is it runs contrary to human nature. We want to be right. And in order to make that happen, we naturally hold on to losses, hoping things will turn around. On the other hand, we take our profits off the table early. Why? Because we're afraid of losing the money we've already made. This is how you lose money trading. It is more important to be profitable than to be right. So take your losses early, let your profits run. Let me repeat that last part again. It's more important to be profitable than to be right. Reflect on that for a second. We've all heard the advice to cut your losses early and let the winners run, but I was doing the exact opposite. My losses were much larger than my wins. Think back to your own trading. Have you ever lost more than you planned? And in hindsight, you think, why would I do something like that? I know I have. Here's a good example of what not to do. A complete disaster of a swing trade that broke just about every rule. We're going to talk about mental stop losses, moving the stop loss, and averaging down. Towards the end of 2007, General Electric's price is falling 40%, but it's approaching major support in my mind. Going all the way back to 1997, resistance turned support, came back and tested in October 1998, rocketing up 158% over the next 2 years. GE retraces, and where did it stop? It tested this level for 5 months at the end of 2002 before ripping up another 80%. The orange support seems reliable. There's no guarantee the stock will go that low again, but it's on my radar, and if it does retrace that level, I'll be ready to pounce. Major gap down of 8%, already halfway to support. Next day, gaps down another 10% lower than yesterday's close, but GE charges up, even closing above yesterday's open. From open to close, we get a massive 13%. GE started trading in 1962, sorting by biggest gains in a day out of almost 12,000 trading sessions. This is the biggest gain ever. So clearly a 13% jump in one day is going to catch a lot of people's attention. Retail traders like you and me don't move the market like that. So in my mind, it seems pretty obvious. The big institutions shorted the stock, wanted to shake everybody out so they can get the price as low as they can and then buy up as much as possible. It seems like all the hedge funds were paying attention to that level as well. I pat myself on the back, and towards the end of the day, I get long 10 shares around 191.50, which is just above yesterday's open. I'm almost certain this trade is going to work, and I set a mental stop loss below the low 6 years ago at 159.94. I plan on having 3 targets. Just before the gap would be 2-1, recent high would be 3-1, and back to the start of the downtrend would be at least 4-1. Here's how the numbers look. I enter at 191.50, stop is $31.56. I bought 10 shares in total, so I'm risking $315. I have 3 take profits. First is at 254.62 minus entry of 191.50 means I make 63 a share. Times 3 is 189. I sell 4 at 286 and 3 at 317 for a total profit of 946. 946 divided by 315, I'm looking to make 3 times my money on what should be a high quality setup. Daily candle is red but holds support, and the next is a further show of strength. I'm feeling pretty confident here. Consider adding to my position, but Decided to see how things play out. This one's interesting. Price gaps up 17%, gives back about half during the day. It's probably worth noting this red candle happened on September 29th, 2008. September 29th, 2008, the single worst day in the last 20 years. And somehow GE still closes above support. In a twisted way in my mind, I'm telling myself even more reasons why I'm right. The next couple of days, stock bounces around and gaps down. It looks bad, but even with everything going on in the news, it still didn't make new lows. The trade starts to go off the rails. 2 days later, GE actually gaps below my stop loss. One of the many mistakes was not using a true stop loss. It was only a mental stop loss, so I'm still in the position. And from the first minute, it goes higher and higher and higher. I'm pretty close to getting stopped out, but in my mind, I know I'm right. I start to tell myself, if it was a buy at 191.50, I'm getting a discount at 164. If I get in now, my average price would come all the way down, just above support here at 177.75. I go ahead and add 10 more. Mistake number 2, adding on to a losing position. Have you ever bought more after the price dropped thinking it's a good deal? The funny thing is, I didn't even want to make money on this anymore. All price had to do was just go up to the orange line and I could get out, break even. After the way things were going, that would have been a win in my book. One mistake led to another, and it would only get worse from here. The very next bar took the wind out of me. I was so close to getting my order filled, but it didn't quite get there. The rest of the day slammed lower, and it's definitely below my mental stop loss. Think back to a time in your life when you've invested so much time and energy into something. You kept dragging it along, but it just didn't work out. Maybe it was a bad relationship or a job you hated. We've all been there. And in the back of my mind, I thought, well, maybe things will just get better on their own. Sometimes in trading, just like in life, it's easy to fool ourselves instead of cutting the loss and moving on. At this point in the trade, was watching General Electric for over a month and been in the trade for 3 weeks. For me, sometimes it's hard to admit when I'm wrong. It's not just the money. I've already invested too much time and energy to want to quit now. For the longest time, I wasn't able to separate a losing trade from feeling like a loser. I used to take it so personally when I get stopped out. Have you ever ruminated on a trade, played it over and over again in your mind? I get frustrated. I get anxious. Start thinking I'm never going to make it as a trader. It's like my entire financial future was riding on the outcome of this one General Electric trade. I'd convinced myself I needed to make this one trade work to grow my account faster. Then I could trade bigger and be that much closer to financial freedom and having control of my life. Because of that, I decided to give the trade a little more room to breathe. Flipping back to the chart, the following candle shows a little sign of strength. I'm starting to get my hopes up, only for them to come crashing down the next day. Have you ever been in a trade where you know the right thing to do, but you're like a deer in the headlights? In the next video, we'll go over how to place your stop loss and manage your trade. But for now, let's think about why I opted for a mental stop loss instead of setting a hard stop and automatically getting taken out of the trade. It might seem obvious, but a stop loss actually has 2 parts. One is the dollar amount I'm risking. My stop loss is a little over $30 away. I bought 10 shares. $300 is $300, but I'm not going to panic over it. So number 1 is the actual money. Number 2 is a little more sneaky. It's the possibility the trade will actually go against me. Before getting into the position, I was only thinking about booking a profit. If I'm wrong, I'll just deal with it later. When I put on the trade, there was no doubt in my mind I was right. As Peter Lynch says, there's no shame in losing money on a stock. Everyone does it. What is shameful is to hold on to a stock, or worse, to buy more of it when the fundamentals are deteriorating. As you can probably guess, I did the opposite, and the trade is going to go from bad to worse. So back to the charts. Over the last 7 candles, GE is down over 25%. Yesterday alone, it dropped 11%, and there's no doubt it slammed through my stop loss. At this point, if the next candle doesn't turn around, I'll probably get out. But much to my delight, GE rips up 15%. It's back above my stop loss, and I'm feeling good again. So what do? Obviously add another 10. 3 candles later, it's back below my stop loss, but I'm telling myself it's just testing the low, and I hope things will turn around. Gap back down, but pushed a little higher on the day. If it's towards the end of the day and we're below this green candle, I'm going to throw in the towel. But 2 days later, GE gaps up and keeps pushing. Towards the end of the day, I add on another 10, bringing me to 40 shares total. Here, I even go so far as to start drawing more lines on the chart to justify my position. To make a long story short, I add on 4 more times. So I'm long 80 shares now. Up until this point, I did everything I could to avoid taking a loss, even to the point of ignoring I even had one. But there's a tipping point. When the pain of admitting I'm wrong is overcome by the pain of the actual dollar loss, I see the writing on the wall and set a market stop 87.87 to automatically close everything. Price goes up ever so slightly and then comes down. I'm officially taken out of the trade. The plan was to get out around 160. Instead, this nightmare ended at 87.87, which should have only been a $315 loss, total over $4,200 in the hole. There's no excuse for letting things get that far out of hand, but believe it or not, it could have been much worse. The market actually dropped another $44, which would have cost me another $3,500. Now, if you recall the article from the beginning of the video, after 12 million trades, they were winning 60% of the time, but still losing money overall because the losses were much larger than the wins. I've made every mistake in the book. Let my losing trades run in the hopes they'll turn around, been stubborn and denied I was wrong, never use a stop loss or moving it in the opposite direction to give the trade a little more room. But the true beauty is, once I learned how to take a loss, my results were like night and day. Even if you've been struggling, once you understand what the real issue is, making your money back, that's the easy part. You can always make more money. What you can't buy is time. If you're watching this video, you're searching, you have the drive, maybe you'll eventually figure it out on your own. But my goal for this channel is to save you from wasting months or years like I did, spinning my tires, being so close to a breakthrough, but not having results to show for it. Setting a proper stop loss is a fine balancing act. You don't want it to be too close where price dips down, takes you out, and then continues on without you. But you don't want to set it so far away that you can't get a good risk to reward ratio. There's also a strategy to moving your stop loss as the trade moves in your favor to maximize your profit. Learn the best way to manage your losses. Click the video here, you'll love it, and I'll see you there. Have you ever been in a trade where price wicks down, hits your stop, takes you out, then turns right around and races back up? It's times like that when I used to regret having a stop until I learned to think about it in a completely new way.